The stock market is one of the most powerful financial systems in the world, allowing ordinary people to become part owners of large companies and grow their money over time. Yet for many beginners it feels confusing, risky, or even intimidating. So in simple words, the stock market is a place where shares of companies are bought and sold, and a share represents a small piece of ownership in that company, meaning when you buy a share you technically own a tiny portion of that business and can benefit if the company grows. And people make money in the stock market mainly in three ways. First, by buying shares at a lower price and selling them at a higher price when the value increases. Second, through dividends, which are portions of profit that some companies pay to their shareholders regularly. And third, through long-term investing, where people hold quality shares for several years and allow compounding to increase their wealth slowly. But it is very important to understand that the stock market is not a guaranteed money-making machine, and prices move up and down every single day due to many factors such as company performance, economic conditions, interest rates, inflation, government policies, global events, wars, natural disasters, and even public emotions like fear and greed, which is why risk is always involved, and this is also the reason why beginners should never invest money they cannot afford to lose. Because losses are part of the learning process, and every successful investor in the world has faced losses before achieving long-term success. So instead of chasing quick profits, beginners should focus on learning the basics, understanding how businesses work, how profits are generated, why some companies grow and others fail, and how patience often beats speed in investing. Because many people fail in the stock market not due to lack of intelligence but due to lack of emotional control, as panic selling during crashes and greedy buying during hype often lead to poor decisions, whereas disciplined investors follow plans, manage risk, diversify their investments across different sectors, and think in years instead of days. And one of the biggest mistakes beginners make is following tips from social media without proper research, assuming that a low-priced stock is cheap without understanding the company's financial health, or investing just because others are making money, which can result in heavy losses when the trend suddenly changes. And it is also important to understand the difference between trading and investing, because trading focuses on short-term price movements and requires fast decision-making, technical analysis, and emotional strength, while investing focuses on long-term business growth, fundamental analysis, and patience, and both require knowledge and discipline, not gambling behavior. And another key concept is diversification, meaning instead of putting all your money into one single stock, you spread it across multiple companies or sectors so that if one investment performs badly, others can help balance the loss, reducing overall risk. And this principle is one of the foundations of safe investing, especially for beginners. And along with diversification, risk management is essential, meaning you must always decide how much you are willing to risk on a single investment and never risk everything on one decision. Because the market can stay unpredictable longer than you can stay emotionally calm. And in today's digital age, learning about the stock market has become easier than ever because free educational content is available through videos, articles, simulators, and demo trading platforms that allow beginners to practice without real money, which is highly recommended before investing actual cash, because practicing builds confidence and helps develop discipline without financial stress. And while many people are attracted to the stock market because of success stories, luxury lifestyles, and quick profit videos, the reality is that true wealth in the stock market is usually built slowly through consistency, patience, and smart decision-making over time, not through overnight success. And those who survive long-term are the ones who treat it as a skill to be mastered rather than a shortcut to instant riches. Because the stock market rewards discipline but punishes emotion, rewards patience but punishes greed, and rewards learning but punishes ignorance. So if you are a beginner watching this, the best thing you can do is not to rush, not to copy others blindly, not to invest under pressure, and not to believe every online, guaranteed profit claim, but instead focus on building your knowledge step by step, understanding basic financial terms, learning how companies earn money, following market news carefully, and most importantly developing a calm mindset that allows you to make logical decisions even when prices are falling or rising rapidly, because the market will always test your patience, your fear, and your discipline, and only those who stay emotionally stable and continue learning survive in the long run. And remember that the stock market is not just a money machine, It is a reflection of the world's economy, businesses, innovation, and human psychology, and when you understand these things clearly, you stop fearing the market and start respecting it, and this is the moment when you begin your real journey toward becoming a successful long-term investor.